But you can see the recording from last time. I still have to post up the recording that we talked about, the CPA stuff, the CPA requirements. I don't have that up. But the lecture of the actual slides, complete chapter 1, are now up there. It's in the 2 parts from 5.7 and 5.14. Goal for today is to talk about chapter 2. I'm not sure when you printed that out, but I did revise it a little bit, so there might be some changes. That's the one thing that I'm sure will drive you nuts, that you'll think you have a beat on what I'm going to talk about, and then I'll expand it and change it around a little bit. So, and with any luck, we may even get into chapter 3, which will keep us pretty close on schedule with the syllabus. Okay. I think that's it. If there's not any questions, we can go ahead and jump into chapter 2. Okay. All right. So let's go ahead and take a look at the chapter 2 slides. And as I said, I did revise those from what had been up there a little earlier today. So bear with me if you had already printed those out, Michael. Let's see if they're going to let me open from here or make me go to my files. Looks like it wants to open. Good. Maybe not. Search me, but that's okay. I'll take it from my desktop. Okay, so let's go ahead and get into chapter 2, and we're going to talk about the various standards that are used when we are doing an audit. And we're going to talk about really 2 sets of standards. We're going to talk about standards for audits of non-public entities and public entities as well. So we'll cover both sets of standards. Where they come from, their origins, that sort of thing. We're going to see pretty quickly, though, that to a large extent, the standards that are promulgated by the American Institute of Certified Public Accountants, the Auditing Standards Board of that entity, really are the main source of the standards for both public and non-public companies. So the PCAOB standards, the Public Company Accounting Oversight Board standards, point to the AICPA standards and non-public standards to a large extent. So we're going to see that. And then we'll talk a little bit about some of the ethical considerations and very quickly go through a couple of points there. For chapter 3, assuming we get to that tonight, which I think we should be able to, we'll start to talk about the very beginning of a financial statement audit. We'll go through the planning phase, all the way through talking about considering materiality. Okay, so hopefully we'll get to both sets of information. Now, when we talk about the different types of auditors, we have our external auditors. Our external auditors are the CPAs who come from outside, the big 4 firms, all of different regional firms, local firms. They come from outside the company. They're external. They do the audit of the financial statements. I think when you looked at Apple's financial reports, you saw that EY was the independent external auditor. So those auditors are independent. Now you also have internal auditors. And we're going to see in chapter 3 that often the external auditors will work with the internal auditors, but it's important for us to always remember that internal auditors are not independent from their clients, okay, from the client. They report directly to the board of directors of the company. So they have a high level of objectivity, but they are not considered independent. The only ones that are considered independent are the what? External auditors. And what's what the internal auditors do to a large extent is look at the internal controls that have been established by the company and report back to the board of directors if they think those internal controls are achieving their objective. So they're part of the monitoring process of the internal control system of the company. In fact, they're the main monitoring tool. Okay, government auditors. Okay, my old office, Government Accountability Office, GAO, IRS has auditors, and to a large extent, what government auditors do are auditing compliance with government programs, compliance with various requirements. Forensic auditors, there are a variety of entities that would use forensic auditors. I'm sure IRS uses them. I wrote in FBI here. FBI is not a bad consideration career. I think you can retire when you're 50 from the IRS, which maybe sounds old to you, but that's not very old to me. Okay, so it's not a bad deal. You can retire when you're 50, and they do recruit accountants. They recruit individuals with language skills. Spanish, Vietnamese, Chinese are some of the languages that they recruit individuals for. Of course, you have to potentially carry a weapon. And when I was considering looking for the FBI, what I didn't like about the recruiting material, it said you may have to live with known criminals. I'm like, that's why I went to school, to get out of the known criminals I've been living with my whole life, my family. Some different types of auditors. Okay, audit team. I think that most of you, I started that off, and you should be thinking partner. If you're going to be working for a CPA firm. Okay, you have managers, you have seniors in charge. Of course, you'll start out as associate staff when you start working for one of these firms. And I think Q8 means there's a question that we're going to look at a little bit later. I don't know if it's question 8 anymore, that will deal with the review of work papers by a manager or a senior in charge. Okay? Okay, good. Now let's take a look at where some of these standards that we're going to talk about in this class come from. And remember, we talked about the Sarbanes-Oxley Act, established in 2002, came after some of the scandals, Enron, WorldCom, etc. And Sarbanes was the senator, Oxley was the Republican in 2002. And then the Sarbanes-Oxley Act created the PCAOB. And we're going to see that the Public Company Accounting Oversight Board is the entity that establishes the auditing standards for public companies. And the auditing public company has to follow PCAOB standards. Another significant act was the Dodd-Frank Act in 2010, and that led to quite a bit of some of the Wall Street reform, Consumer Protection Act, etc. So a lot of the regulation has come out of scandals, unfortunately, and it doesn't look like that'll ever end. So you can always count on another scandal and generate another set of regulations to avoid the next scandal until the next one comes along, right? Essentially. Okay. Now, society's expectation of auditor, and I don't know if this is necessarily society's expectation, because people don't walk around saying, these are the responsibilities of auditors, and they don't even think of auditors probably most of the time. But auditors want society's expectations to be that we would provide reasonable assurance that financial statements are free of material misstatements. Remember we said last time, or a couple times ago, it is not absolute assurance, right? It's not absolute assurance for a variety of reasons. For example, we do not test 100% of the transactions, right? There could be collusion going on in which people are working together to conceal things from us. And just the fact that management and or employees of the company may be smarter than us and they're able to get something past us. So for those reasons, we cannot provide absolute assurance, okay? Now, what we have is the board of directors, okay? This idea of corporate governance, so that there's a board of directors that is overseeing the operation of the entity. Okay? Now, the reason I wrote in here, those charged with governance, is you see that phrase much more in the literature than board of directors, because not every entity has a board of directors. If you're auditing, say, a housing agency, they're going to call it a board of commissioners. Okay? So those charged with governance, but it is what? Those that are overseeing the operations of the company. Now, within the board of directors, there will be an audit committee. And that audit committee is in charge of hiring, firing, overseeing the audit and the auditors. Okay? So we have that audit committee. Okay? Now, as we mentioned, our internal auditors will probably report directly to that audit committee. The external auditors, the independent auditors, though, will have responsibility to report information to the board of directors, even though they are independent.
Mm-hmm. So the internal auditors and the external auditors, do they work together or are they?
They do work together. However, the internal auditors work at the direction of the external auditors. So we are allowed to use them, the external auditors are, okay, but we have to be satisfied as to their objectivity and their competence, and we are not allowed to share any decision-making process with them. So if it comes to making assessments of risk or making judgment calls, that rests solely with the external auditor. But that doesn't mean that we can't use them to help us to understand the internal controls, to help us to get certain documentation, to help us to facilitate discussion, that sort of thing. But we cannot punt any, by punting, turn over any judgments, etc. to them. And we'll talk in Chapter 3 more, the process for using the work of those external, internal auditors. But there are some limitations on that. But yes, we can work with them. Yes. Okay. Oh, am I playing my narration of the slides changing on me here against my will? I have to turn off the narrations, I think. Yeah, if I play narrations, it'll just change on me. So I'm wondering if... No, I don't think it was playing. I didn't hear anything. I don't know. You might hear double voice on there for some of these slides. What I was saying originally and then my voice coming into the microphone at the same time. I don't know. Check 1, 2. I'm still recording. So if that's the case, guys, bear with me for some of those slides. If you watch that, you might want to skip past those ones where you're hearing my voice when I recorded this the first time and hearing me talk again. But that should be fine now. Okay. All right. So taking a look at organizations that affect the public accounting profession. Okay. And you have on the accounting side the Security Exchange Commission. And the Security Exchange Commission is the entity that has the authority to set accounting standards. Now, what they do is they go ahead and they turn that authority, you know this is distracting. I don't want this like this. Let me go ahead and keep it in this mode so I can see what the heck I'm doing my markings. Well, you can still see them. Still see the slides, okay. So if you take a look, we have the Security Exchange Commission. Security Exchange Commission is the entity that has the authority to set accounting standards. Okay. Now, they have delegated that authority to the Financial Accounting Standards Board. So they turn to the Financial Accounting Standards Board and say, you go ahead and you can audit the, not audit, but you can set the accounting standards. Okay. Now, you come over and we have the financial accounting reporting exam, if you're thinking CPA exam, is really the part of the CPA exam that covers what the FASB does. Okay. Now you also have the International Auditing and Assurance Standards Board, the IAASB. That's covered a little bit on the auditing part of the CPA exam. You have the Public Company Accounting Oversight Board. That sets accounting standards for public companies. That's on the auditing section of the exam. The American Institute of Certified Public Accountants, the AICPA, sets the auditing standards for the non-public companies. And then you have the International Accounting Standards Board, which it seems to me like those two, I don't know why one's on one side and one's on the other. It doesn't make sense that they flip them over to one side and the other, the auditing standards and the International Accounting Standards, because we lined us up wrong on that last part. Okay, and that really promulgates IFRS, and that's also on the FAR part of the exam. Okay, now what is interesting is that for years it was questionable as to whether the Securities Exchange Commission had the authority to write the auditing standards. Okay? And what Sarbanes did is it came down and said, yes, SEC has the authority to write auditing standards. They created a PCAOB, though, however, to do that, and then the PCAOB writes the auditing standards for public companies. So the Securities Exchange Commission really has the authority to write the auditing standards, and it was Sarbanes that pointed to the SEC. But the SEC has had the authority to set accounting standards now since the 1930s. Okay? All right. Now, when we look at our auditing standards, if we're talking about the Public Company Accounting Oversight Board, they have about 20 standards that they have issued, okay? And they call those auditing standards, and those are the standards that we follow when we audit public companies, okay? The AICPA has the Auditing Standards Board, and they issue statements on auditing standards, and there are hundreds of those. Okay, there are hundreds of auditing standards when you're auditing non-public companies. Now you look at that and you think to yourself, well, great, then I just want to audit public companies because there's less standards I have to follow. But the reality is that the PCAOB really, and maybe the arrow should be going this way, okay? The AICPA, the auditing, the PCAOB standards, to a large extent, point to the AICPA standards. Okay? So what happens is the PCAOB standards really build upon the AICPA standards. So we have hundreds of the SASs and only 20 auditing standards from the PCAOB, but because the PCAOB points to the AICPA standards and then adds upon that, you really have more responsibility with public companies than you do with non-public companies. Okay? And then you have the international standards, and the international standards and the U.S. auditing standards have worked now to try to make the language in these standards as close as can be. And there was a project a few years back called the Clarity Project, in which they really revised the language of the AICPA auditing standards so that they match better what the International Accounting Standards Board has promulgated, and say that over 100 countries use these. So you've got what? You've really got the AICPA being, to a large extent, the driver of what has to happen in the auditing standards, but the PCAOB has come in and weighed in with additional requirements. We have about 20 standards now. So you can see that when you look at the standards and you look at your standards for, and by the way, guys, non-issuers and issuers are sort of synonymous terms. Okay, but you can see non-issuers up here, and I'm going to go ahead and change my pen. I think I like the red better. So you've got non-issuers, that's the synonymous with non-public companies, and they have their auditing standards board, which is part of the AICPA. When they issue a standard, they call it Statement on Auditing Standards, otherwise known as a SAS. These are chronological. Okay, so they issue those chronologically, SAS 1, SAS 2, SAS 3, SAS 4, hundreds. But then what they do is they turn around and they codify those standards by topic. I'm going to show you a slide in there that will show the different topics that they codify these by. And when they codify them by topic, they call them out as AU Auditing Standard. And the C stands for the Clarified project that they had a few years back, where they aligned the U.S. auditing standards more with the international standards. Okay? So there's two ways to refer. Sometimes you see SAS this, SAS that. Most of the time the way we'll refer to them here in class, though, will be AUC, because that's codified by a particular subject. I will never ask you a question, by the way, guys, well, I expect you to be able to cite an auditing standard. You have to go into that. But you should know that they are codified by subject, by area of the audit. Okay? Now, when you deal with the Public Company Accounting Oversight Board, they have ASs. Those are auditing standards. They issue those chronologically. As I've said, there's about 20 of those, and those are for public companies, otherwise known as issuers. And as I've stated here a couple times now, to a large extent, the public company standards just point to what the non-public company requirements are, and then they add on. For example, they require that there be an opinion given on the internal control of a company, whereas the U.S. standards do not require that opinion on internal control. Okay? So some areas where they add on. I went ahead and put left on this slide here the generally accepted government auditing standards, GAGA standards, are promulgated by my old office, the GAO, if you're auditing a federal entity, or if you're sitting there and you're auditing, say, a entity that receives federal financial assistance, then you would follow generally accepted government auditing standards. We won't get too much into that in this class, but it could be financial audit, it could be performance audit that you'd be looking at there. Coming over, there are also a Code of Professional Conduct that is put out by the AICPA. And it talks about how members of the AICPA should behave in the practice of public accounting. Now, sometimes someone might look at that and say, well, good, I just won't join the AICPA. I won't become a member of the AICPA, and then I won't have to sit here and follow their code of conduct. Well, what happens is each state has an accountancy act. For example, the state of California has an accountancy act that mirrors the AICPA's code of professional conduct and then adds on some additional things. The State Board of Accountancy has the authority to issue your license, and they can take it away your license. So if you don't follow their requirements, you will lose your licenses. So this is how the Code of Professional Conduct does very much come into play, even if you're not a member of the AICPA, and the Accountancy Act mirrors to a large extent the requirements of the AICPA Code of Conduct. Okay? And then we have this system on quality control standards, and we'll talk about quality control standards. How does a CPA firm make sure that its engagements are done according to the auditing standards that we're talking about? We're talking about the ASB standards, the PCAOB standard. We're going to see that entities will establish a system of quality control so those audits are done in accordance with the standards. So while the PCAOB, the Auditing Standards Board standards tell us how to do the audit, the quality control standards tell us what? How to structure our firm to ensure that we're following the auditing standards that are put out by the PCAOB, put out by the Auditing Standards Board. Now again, these standards are, quality control standards are promulgated by the AICPA. And here's how the AICPA makes sure that firms follow those standards. Firms are required to receive peer review. And in the Accountancy Acts, in California, in the Accountancy Acts, they say that a CPA firm has to have a peer review, and it has to be done by an accepted peer review program. And the peer review program that is accepted by the state of California is the AICPA's peer review program. So you have to register with the AICPA's peer review program to find a firm that will do a peer review for you. And that peer review looks at your quality control scheme, your quality control system, I should say. And so, if I'm a Big Four firm, peer review means that another Big Four firm will look at you. If I'm a regional firm, another regional firm. Local firm, local firm. So it is a firm of equal size, stature that does your peer review. And we'll look at the quality control standards here to see what it is that the peer reviewers are looking for when they conduct those peer reviews of our work. Okay, good. So let's go ahead and talk about generally accepted auditing standards. And we're going to see that there are some high-level standards, and statements on auditing standards are considered to be the minimum standard. Now, what happened is PCAOB adopted the GAS standards around the time the PCAOB came into existence. Sarbanes-Oxley was 2002 and created the PCAOB, and they're a brand new entity. Haven't really had time to write auditing standards, so they immediately did what? Took the AICPA's SAS's, Statements on Auditing Standards, and adopted those as their standards, right? And then over the last, 20 or so years, what they've done, a little less than 20 years, what they've done is what they have added on about 20 standards that get specifically the things they would like you to see do for public companies. Okay, so again, the PCAOB standards to a large extent wrap in the SASs for non-public companies. Okay. SASs are classified by two numbering categories. SASs are basically chronological. The AU, and guys, it's AUC. Okay, sometimes the textbooks have trouble keeping up with things. It's AUC. Okay, not just AU. AUC, which stands for the clarified standards, the C does, codifies them by topic. Okay? So if you take a look, SAS 39 deals with audit sampling. That was the number. It was the 39th SAS that was issued. So it was issued some time back, right? So SAS 39. But then when it's codified, it's codified in the risk assessment and respond to assess risk part of an audit. So when we look at the codification, again, the AUC categorization, it goes to whatever particular part of the audit that it is relevant to. In this case, it would be in the risk assessment in response to assess risk section of the standards. Okay, it's in the 300 section. You can see 700 deals with reporting, 600 use of others work. You asked me about the internal auditors. If we wanted those issues that I was telling you about how we use the internal auditors, if we wanted to find that out, we'd go to AUC 600 to find out what the requirements are there. Okay? So if you look here, I think this does a nice job of sort of laying out the AU standards and how they're laid out in AU section. AU 200 to 299 is general risk assessment and response. We saw that in the previous slide, 300 to 499. And then you can see the codification sections as they relate to auditing standards for a different numbering system, and to a large extent, they're pointing back to the AICPA standards and then adding some additional requirements to simply taking care of this. Okay, good. So let's take a look at a question, and I've tried to, in these chapters 2 and 3, embed the questions next to where it's related to the subject. So what will happen is when you're working the homework questions, we're working the quiz questions, you might think you're having a deja vu. Hey, where have I seen this before? They may have already been in the slides. In some cases, you'll only see that question in the slide, and it gives you hopefully cause and effect when it gets to what we're talking about and some of the questions. Okay, so let's take a look at this one. Which of the following could serve as a source of professional guidance in the audit of a public entity? And notice that both what? Both the PCAOB and the auditing standards boards are indicated here, because again, PCAOB points to the auditing standards board standards for auditing standards. And which of the following is not true with respect to the responsibility of establishing generally accepted auditing standards? Let's start at the bottom. If specific guidance is not provided by the PCAOB, auditors may refer to statements on auditing standards that have not been amended or superseded. Well, that is true, isn't it? To the extent that the PCAOB standards don't cover something, you could look to the auditing standards board standards to see what you're supposed to do, right? The second from the bottom, the PCAOB is the body with formal authority for the creation of auditing standards for the audit of public entities. That's right. They're the entity that is recognized under Sarbanes-Oxley to do that, right? Okay. Choice B, whatever. Interpretive publications are issued by the AICPA to provide guidance on the application of generally accepted auditing standards in specific circumstances. Yeah, they have things that provide guidance, etc. And then the one that is not true, auditing standards for both public and private entities must be formally approved by the Securities and Exchange Commission. SEC gets involved for what? Public entities, not non-public entities. Right? So that is not true. Okay? Okay, good. Let's take a look at this as sort of more of an exercise in a multiple choice question. This is the kind of thing that if you were looking at the CPA exam, you might see in a task-based simulation. Okay, we will have questions of this nature on your exam. Okay, and here as well, remember we said we'll do one problem where you're actually having to work through matching, that kind of stuff, in addition to our multiple choice questions. So I figured it was okay to put one of these in. So for each of the statements below, indicate through the appropriate letter whether it relates to the PCAOB, Auditing Standards Board, both, or neither. Okay? So conducts inspections of firms that audit public companies. That's the PCAOB, isn't it? Okay, and we're going to see what some of the requirements are here as to how frequently you will get a look from the PCAOB. And essentially, if you do more than 100 audits of public companies, you're going to get looked at every year. If you come under that 100, then it's something like every 3 years or something like that. Okay, and we'll see what some of those requirements are in a minute. Pronouncements may be used in the audit of non-public entities. That's who? That's AICPA, isn't it? Pronouncements may be used in the audit of public companies. Huh? The choices are PCAOB, AICPA, or both. That's both, isn't it? Right? To the extent PCAOB doesn't cover something, AICPA standards can be used, right? Was created by Sarbanes-Oxley, PCAOB. involved with the certification and licensure of public accountants? Well, it's neither. Okay, now I see why you might want to say AICPA because they write the exam that all 50 states expect you to pass, but the actual certification comes through the state, right? So even though the AICPA writes the exam, the states administer it. It's up to the state to decide to even let you sit for the exam, right? And the state will then get your scores after the AICPA corrects the exam, and then they're going to monitor you to make sure you're keeping up your continuing professional education, etc., right? Okay. Issue statements on auditing standards. AICPA, good. Conducts peer review of non-public entities. Well, the official answer is neither, okay? Even though they say that it has to be in the state of California, they say an accepted peer review program, and the peer review program that the state has accepted is the AICPA's program. The entities that actually conduct the peer review are the peer review, the peer CPA firms. So it's going to be Big Four to Big Four, et cetera, right? So, okay, kind of a tricky question. Sanctions individual auditors for violations of generally accepted auditing standards. Neither. Okay. What happens? I'll just put an N there for neither. Okay. What happens? If you have, when you get a peer review, you can get a peer review of pass with deficiencies, and then you start getting into hell like non-acceptable, that sort of thing. And what they'll do is they'll refer you then to your respective state board. And the state board will be the entity that then will work with you to cure your ills. Okay, so, and if you do something wrong, you know, as a CPA, they're the ones that'll sanction you. Okay, probably not a bad idea at some point to get the quarterly letter of the State Board of Accountancy, and you turn it back, and you read about all kinds of horrible things that happen to CPAs because they didn't follow the standards, they did the wrong thing, that sort of thing. And sometimes I read some of the things back and I'm like, what was this person thinking? You know, there's some really crazy things like they conducted an audit but had no documentation. So they got peer reviewed and basically they didn't do anything. They just issued the report and there's no work behind that. Okay, so you know, these kinds of things, you know, how do something like that happen? Okay, but it does. So they did an audit and their license was expired. Then they went ahead and gave the report anyway. I mean, these are the kind of things that you're going to get busted out on. Okay? Now, there's also things that you think have nothing to do with accounting and audit. For example, you get a DUI, driving under the influence. They will sanction your license. They can suspend your license for that kind of thing as well. And there's an expectation that CPA will hold a high level of integrity and responsibility to the public, and that extends beyond just the conduct of the day-to-day operation of CPA. Okay? Okay, good. So, that's, I think, the answers. Did I get them right? Neither. AICPA is the auditing standards board. Good. Neither. PCAOB. Both. AICPA is the auditing standards. The PCAOB. Good. I got them right. Okay? Question? So when we get to like full-blown problems, I'm going to give you something like this. Okay, on the exam. We'll practice this. Okay, good. So that takes us through the standards. I think the big takeaways from that is that what? You have two standard setting boards, one for non-public, one for public, right? Public's PCAOB, non-public is the auditing standards board, but what? To a large extent, PCAOB points to the auditing standards board standards, right? And then I think the other big takeaway there is just that we have a statement on auditing standard call out, auditing standard call out, or that is a chronological listing of standards. Probably more importantly for us, though, to understand that those standards are codified by section of the audit. Okay? And so you'll see some references sometimes to AUC or auditing standards such and such. You go through and talk about some of the requirements. Okay? Okay, now let's talk about the engagement. Well, let's do the overview first. Okay? Obviously, that's these kind of golden slides up here. Obviously, before you do an audit, you have to obtain a client. Okay, now this or retain a client. This is, very important because you don't want a client whose management lacks integrity. That's a big problem, right? It can bring down the CPA firm. Can you think of a CPA firm that is brought down by a client that lacks integrity? Enron was a client that lacked integrity. What was the name of the CPA firm? Right, Arthur Anderson was the firm that got brought down because Enron did some wrong things and they weren't minding their P's and Q's about maintaining that client, and away they went, right? So it's kind of a big deal, okay? Then we're going to get into engagement planning. So we'll pretty much do that in this chapter, and in chapter 3 will be an engagement planning discussion, okay? We're going to go through risk assessments. We'll get into that more as we go down the line into chapter 4. Audit evidence, and we'll talk a little bit about the nature of audit evidence in this chapter, but we really start digging into the specific types of evidence for the particular type of cycle and accounts, probably around chapter 6 or 7 when we start talking. We'll start with sales revenue cycle, okay? And then we'll finish up towards the end with reporting. Now we're going to talk a little bit about the reports today just because it's kind of hard to talk about all the rest of this without an understanding of what our ultimate product is, which is the report. We already looked at the report for Apple in our first class, so we already have some familiarity with that. Now, what happens? We're going to see that we're going to look at responsibilities, competence, capabilities, independence. Okay, now these really get into every aspect of the audit, and you can see that we still have our responsibilities, right? Are going to get into every aspect of the audit. Our responsibilities are going to include professional skepticism, professional judgment, and due care. But when we talk about maintaining our competence, capabilities, our independence, that really extends to everything we do, right? So that's why we're not listing those out by the other parts of the audit. We're going to have performance, and we're going to talk about reporting. Of course, reporting touches on reporting. So, again, responsibilities, okay? And we're going to look at our gas and our principles here as they relate to responsibility. Then we'll talk about performance. We'll talk about reporting. And then towards the end here, we'll talk about the quality standards for the practice of public accounting by CPA firms. Okay? Okay, responsibility principle. Okay, competence and capabilities. We have to have experience. We have to have expertise. So, where can you gain expertise? Work experience? You can gain expertise through work experience, okay? We've got experience up there, but also expertise is acquired through what? You're doing it right now, education. Expertise is acquired through what? Through taking and passing CPA exam, right? It is acquired through continuing professional education. So it is not enough just to get your education past the CPA exam and get your license. You have to maintain your continuing professional education throughout your career. Okay? What are the requirements of the state of California? you have to have 80 hours of continuing professional education every 2 years. No less than 20 can come in any 1 year, and then depending on the nature of the type of engagement that you're involved in, they may add additional requirements onto that. 80 is the total, but they can break that 80 into different categories. For example, if you're involved in government audits, you have to have 24 hours of continuous professional education. It's hours, guys, it's not units. It's not like you're getting 3 over again. It's hours of time that you spend. And you have to spend at least 40 hours in class. You can get 40 hours doing what I'm doing right now, which is talking about this stuff, but at least half that time has to be actual seat time. You don't have to be in class because you're not wrong or whatever, but you have to have 40 hours of actual student time. Okay? Okay, good. Independence is another responsibility. Okay? And we have to be independent in fact and in appearance. Okay? So, independence in fact means that I cannot hold an investment in a client. I cannot hold an investment in a client. So it's inappropriate for me to hold, say 100 shares of a client that I'm auditing. Independence in fact. Okay? But you also have to be independent in appearance. Now, what does that mean? Let's say I hold 1 share of stock in a audit client, and that 1 share of stock is worth $1. Meanwhile, I have a practice that is worth $100 million. Am I going to risk my practice over $1 worth of stock? Right? But the appearance that would create would violate the independence requirement because I have what? Even that 1 share, no matter how small. So it does not matter how material that share is to my overall wealth, etc. This is one area, and we're going to talk about materiality in chapter 3, and it's all about, is it material, is it material, is it material? This is one area where materiality does not matter. Even if it's just $1 worth of stock, the appearance of a conflict of independence would cause that to be a violation of independence. Okay? Now, is it okay to have an indirect ownership in a client? I'm auditing a mutual, I have a share in a mutual fund. The mutual fund holds a share in my client. Can I audit that client? Yes, an indirect interest is okay. Okay, so it is okay for you to audit a client if you're holding a share in a mutual fund that holds a share in the client. Now, we have to be a little bit careful there. If the mutual fund only held shares in your client, then that could be problematic. Okay? But assuming that mutual fund is what they're supposed to do, is properly diversified and whatnot, then it should not be it would not be conflict of independence standard if you held a share. Mutual fund that held a share in the client. Indirect is okay. It's direct. Okay? How about, obviously those are financial, how about managerial relationships? I had a former student, they called me up and said, I was approached by a client today, and they want me to serve on the hiring committee for their accounting staff. So I forget what position they were looking for, something like that if their client. They wanted her to serve on the selection committee. Is that okay? You can't audit.
they're employed after their audit, it's like during your audit, if they're working for them.
Well, let's talk about that. If they start to talk to you about employment while you're on the audit, then you have to immediately recuse yourself from that audit. If they're talking to you about employment, you have to get off of that audit. And then if you were to go over, what happens is, let's say you go from the client to the audit firm, and you can't audit that period, and you're auditing your own work. Okay, so that's where there's hiring going on back and forth between the CPA firm and the client. Okay, so you can't be on the audit and then go over and be on the client when you were already doing audit. You have to immediately recuse yourself from that if you're going to go over to the client. If the client is coming to the CPA firm, they can't audit the period covered by their own work, and they have to recuse themselves from that particular set of audit work. But what I'm talking about is she was asked to sit on a hiring committee that would hire a third party as their, and I forget the position, I don't know if I forget a controller position or a manager position or something, and they wanted her to serve as part of the hiring committee. She was going to stay with the firm. She was going to sit on the committee that was going to select this position, and we said controller. Is that okay? No, you can't do that. You can't be involved in what? Managerial decisions. That's a managerial decision. You're being involved in selecting the individual that's going to come and work, and then you're going to turn around after that and supposedly be auditing that person's work. That would be then auditing a managerial decision that you helped to make, and that is not allowed. Due care, level performance, it would be performed by an auditor, a reasonable auditor in similar circumstances. We talked about professional skepticism last time, and I'm going to give you an example of professional skepticism where something doesn't sound right to you, okay? You're required to follow up on that, understand what's going on, questioning, critical assessment, judgment, okay? And judgment, guys, if you look at all the professional literature, it always comes down to judgment. Okay, sometimes you'll see questions in our homework and on the CPA exam and stuff, and they'll sit there and say, under which of the circumstances may the auditor defer their judgment? And the answer is, the auditor may not defer their judgment. There is no substitute for judgment. And nothing substitutes judgment. Okay? Okay, so that takes us through the responsibility principle. So let's take a look. Which of the following would most likely be a violation of the independence requirement found in the responsibility principle under generally accepted auditing standards? And so an auditor on the engagement has a distant relative who's employed by a vendor that does significant amount of business with the client. No, okay, that's not going to violate. You could have a situation where your spouse is the CFO, you're the auditor. Yes, that's going to be a problem, right? That's going to violate the independence. What if your spouse is a truck driver for the company? Is that going to violate the independence requirement? No, presumably, unless they're the truck driver and the CFO. Okay, assuming that they're not involved in any of the day-to-day accounting operations, that would be okay. Okay? All right, good. Number 2, the client's chief executive officer graduated from the same university as the partner. Okay, some of these questions, these choices I read, and I have to fight and laugh at. That's not a problem. An auditor on the engagement owns a financial interest in the stock of the client. Yes, no matter how small, right? No matter how small. It probably should be more specific instead of the red, but that's okay. It's still that's it. The client provides financial support to a number of charitable causes that also receive support from the accounting firm. Okay, good. Under generally accepted auditing standards, which of the following relates to the responsibility principle? Initial planning of the audit engagement, that's going to be part of our performance principle, but not the responsibility principle. Confirmation of account receivable, that would be a particular procedure that we would follow probably under the performance part, but not under the responsibility. Remember, we've got responsibility, performance, and reporting, right? The completion of internal control questionnaire, again, yes, on performance, we're going to do that sort of thing, but not under the responsibility area, right? And then maintaining professional skepticism and exercising judgment, yeah, we saw that on the slide. Okay. Procedures issued by the Public Company Accounting Oversight Board are subject to formal approval by the Security Exchange Commission. Now has that authority. And it was a little bit silly, you know, before Sarbanes-Oxley came out, the AICPA was trying to say, no, we're the entity that's supposed to set auditing standards, but it wasn't anywhere in any legislation. And then you had all the, and they were kind of getting away with that. And they said, yeah, we're the entity, but it was not in any legislation. And the reason I know that is I was on an assignment where Congress asked us to look at the accounting standard setting process and the auditing standard process in the United States. And it was very clear that the SEC had the responsibility to write accounting standards. That was a no-brainer. That's clearly the 3334 Act. But when you looked around for anything other than the AICPA claiming themselves as being the ones that should write the auditing standards, there was no federal legislation. Okay, so what happened? You go on, that was in the late 90s that I was doing that work. You go along into the 2000s, it's probably in the 80s. About 10 years later, that's when Enron blows up and Congress gets involved and they say, well, since it's not clearly written in legislation who sets the auditing standards, they put in Sarbanes-Oxley, it's the SEC. And the SEC, like it delegates that authority to what? To the, for accounting standards, the Financial Accounting Standards Board, they delegated that authority to the PCAOB. And then PCAOB has slowly written additional standards that they point to the AICPA auditing standards, the SASs as well, in areas that they don't cover. So if you're the AICPA, you kind of got your comeuppance at that point. You kind of got slack and told, okay, sit over there and do what we tell you to. And so that's why I think I did the little play act the other day, that when the Auditing Standards Board comes out with a new standard, they kind of go to AIC, to the PCAOB and say, when you take a look at this, and they don't look them in the eye because they don't want to be destroyed again. They just sit there and say, will you take a look at this? And so there's collaboration between the two. Because the AICPA doesn't want to end up being the entity that only writes the standards for what? For non-public companies. So that's how you end up with that collaboration. Okay, good. Performance. Okay, let's talk about the performance area. Okay, and again, you can see some of the things that we saw in that one question that I was saying it's not responsibility, but it is performance. Okay, so performance, preparation of an audit plan. Audit plan, guys, must be written. There has to be a written audit plan. Must be written. There must be a written audit plan like every audit. Okay? Materiality. We have to think about what sort of information could affect the decision of users of the financial statements. And when we think about materiality, we're going to see that we not only think about it, we're required to think about it in quantitative terms. We're going to have very specific quantitative considerations that we have to make in our materiality judgment. But we also have to think about qualitative aspects. And I think I gave the example the last time. If I had known that the financial statements were misstated by $25 million, I would have never bought the stock. That's an obvious what? Quantitative issue that changed the decision of a user, right? If I had known that the financial statements were misstated by $25,000 because of management fraud, I would have never bought the stock. Now our quantitative threshold has diminished quite a bit, but it's what? The qualitative aspect of it being caused by management fraud that made that a material fact. And we have to make those assessments on every performance in every engagement. Okay? Risk assessment. And we're going to get into risk assessment more in Chapter 4. So I'm just going to tell you right now, on every audit, we have to obtain an understanding of the entity's environment, including its internal control, and we have to make an assessment of something called the risk of material misstatement. That assessment of the risk of material misstatement will determine the timing, extent, and nature of further audit procedures, including any testing of operational effectiveness in internal control, and also making an assessment, and then finally our testing operating effectiveness in internal control, and then we will always have to do some substantive testing. So there's further audit procedures, substantive testing, control testing are determined by what we must do on every audit, make an assessment of the risk of material misstatement. And we'll get into that in some of our other chapters here coming up. I'll start with Chapter 4. Okay? Audit evidence. There must be sufficient audit evidence to support our opinion, and it must be appropriate. Okay? Sufficiency deals with the quantity. For example, how many transactions should we audit in order to support our opinion on our financial statements? Now, the standards don't come out and say, well, you have to look at 100 transactions. It is relative to what? Whatever the sampling indicates would be a reasonable sample that would be representative of the population, right? And we'll talk about sampling in some of the later chapters, but that is going to really govern the sufficiency. The appropriate of evidence gets into the quality of evidence, and we're going to talk here pretty quickly about what constitutes qualitative evidence. And we're going to see that there's literally a hierarchy of evidence, and some evidence is, not all evidence is created equal. But the auditor's direct personal knowledge has a higher quality of evidence than what? Than oral evidence, say, given by the client. And so we're going to see that we're going to have to get some of that higher quality evidence, particularly if we have a particular financial statement assertion that is very important to our users of the financial reports. And we'll talk about that. So it's both sufficiency and appropriateness or quality of evidence. Quantity, quality. Okay? Okay, good. Let's take a look at our reporting requirements. Okay? So for our reporting requirements, we are really going to have to express an opinion. We express an opinion, and that opinion is explicit. That says explicit. That opinion is explicit, meaning the report says, in our opinion. It's an explicit statement. Must be explicit. Okay? We will say, in our opinion, the financial statements were prepared in accordance with, and we'll call out the framework. Most of the time, U.S. GAAP for our purposes, but He could be auditing to see if they're in compliance with, say, international financial reporting standards. This depends on what the applicable framework is. Okay? Could be a special purpose framework. For example, if I'm an insurance company, I have to prepare a set of financial reports that are in accordance with the National Association of Insurance Commissioners accounting standards, and I have to file that report, those financial statements, with the state insurance commissioner. State of California, for example, has a state insurance commissioner, and insurance companies that are doing business in California have to have those reports filed with the state insurance commissioner. In fact, you can go over to the state insurance commissioner's office and look those reports up. I remember I went over there to look at some reports because I was looking, Congress asked us to look at annuities that were being offered by insurance companies. The problem being that you retire, you have this nice pension, you have this 401k, and then when you retire, your pension will buy an annuity from you from the insurance company. But the insurance companies are regulated by the state, and there is no state backing of insurance companies. So if an insurance company goes bankrupt, and the insurance company is paying you your annuity, you lose. Meanwhile, if you had a pension, that pension is covered by the Pension Benefit Guaranty Corporation, which is a federal entity, so you have your pension backed by the full faith and credit of the federal government. So Congress wanted us to look at to what extent there were people that were getting their annuities from insurance companies, and what was the exposure if you had an insurance company that went under, all of a sudden there'd be retirees that would lose their pension. We estimated in that report, I got stuff estimated, that there were about 3 to 4 million Americans at that point in time that were at exposure because they were holding annuities from insurance companies that had no state guarantee. If the insurance company went under, they were regulated by state and federal safety net go forward. But anyway, so I go over to the state insurance commissioner's office, and the people who that I remember there is on the computer system, it kept popping up the name of the insurance commissioner, John Barramundi, is what was showing up on the computers, and I was laughing because I'm like, why doesn't it say Department of Insurance? Why does it give us the insurance commissioner's name? And then he hit me, because he's a politician, and he wants his name out there, and he's now, congressman in California, it's a politician right back. When they file those reports, they have to file certain more conservative rules as to what assets they list. So things like office furniture, they don't list that as an asset because they're looking at protection or the assets that are available for people that are getting insured. They don't want to hear about how they're going to sell off the office equipment, right, to cover that. And so they have to file the reports following a different set of standards. We call that regulatory accounting practices, or actually statutory accounting practices. It's SAP versus GAAP. And so if you were auditing, those reports have to be audited. So if you were auditing those reports filed with the state insurance commissioners, that would be an example of a special purpose framework, and you could give an opinion about that. Okay? But for the most part, we'll be focusing on GAAP, U.S. GAAP. Okay? Okay, good. The responsibility principle under generally accepted auditing standards does not include. Does it include responsibility include competence and capability? Yeah, we saw that. Independence, right? Due care, we saw that. But what? Planning and supervision falls under the performance requirements, right? So even though it is a principle, it is not a what? It is not a responsibility principle. Okay? All right, let's look at the reporting principle. Okay? And when we look at the reporting principle now, Well, we already were looking at it, so maybe my positioning of that question is not very good. I should have probably put it before the reporting, because we're in the reporting now. Okay, but whatever, there it is. Okay, so we're still talking about reporting, okay? And when we talk about reporting here, notice major items in the auditor's report, and there is an explicit call out of management responsibility, a explicit call out of what? Auditor's responsibility. We call out the standards. Now right here they just referring to PCAOB, but it could also be what? The Auditing Standards Board standards, if we're looking at a non-public company. Okay, but whatever standards we audited, and then we have to give an opinion on the financial statements. And then if we're a public company will also be required to do what? Give an opinion on the internal control. That is something that came out of Sarbanes. Section 404 of Sarbanes said that when we audit a public company, we must also give an opinion on the internal control. That's public company law. Okay? Okay, good. So let's just take a look. This, guys, is the non-public company report. Okay, non-public. Okay, and let's take a look. Do they talk about management's responsibility? There's a whole paragraph dedicated to management responsibility, right? They talk about auditor's responsibility, and we are to express an opinion. Okay, and notice that they tell us that we follow generally accepted auditing standards in the United States of America. That's the AICPA standards. So when they say that they're following the standard generally accepted in the United States of America, that means the AICPA standards. We're going to see when we look at the public company report, they're going to specifically call out the Public Company Accounting Oversight Board standards, the PCAOB standards. Okay, and then there's that explicit opinion. Okay, now I'm not going to get heavily into the report issues for our first midterm. I might ask you one question about, do you have to have an opinion under the reporting principle? And the reporting principle tells us yes, you have to give an opinion. We are going to study these reports in depth towards the end. In like our last couple chapters, we start getting into the reports more in depth, okay? But I'm just showing you what the reports are looking like here, since we are what? Since we're talking about the reporting principle right now. Okay? If it is a public company, notice, guys, something very different between the two reports. Both have the opinion, don't they? But for the public company report, the opinion comes first, doesn't it? Okay, so that's the first thing they want you to know, is that we are giving this opinion. And then notice that what? They start to come down and give you some of the other things, like we follow the PCAOB standards. SEC and PCAOB standards. Notice that we still have what? The responsibility of management and the auditor. Management is responsible for financial statements. Our responsibility is to express an opinion. Okay? So if you kind of look back at, what we saw here on this slide, management's responsibility, auditor's responsibility are key parts of the reporting requirements, right? Okay? Of the reporting standards. Okay? The standards that you conducted the audit with, PCAOB or Auditing Standards Board standards, are the ones that they said in the United States of America. Okay? And then what? Yes, the opinion And then there also needs to be the opinion on internal control, and that apparently was in a separate report. Okay, so there would be a separate report that would talk about the reporting on internal control. Usually they're supposed to point to each other, though. This is not the best example. There's something missing here. Okay, and remember when I showed you this example? Remember when I showed you Apple's report? It pointed to the internal control opinion. Okay, so they can either be combined in one report, or the report on the financial statements will point to the report on internal control. The report on internal control will point to the opinion on the financial statements. So it's supposed to point back and forth to each other. So this example is missing a little something here. Okay? Any questions? Okay, we'll become intimately involved with these reports later. Okay? But we just wanted to see some key aspects. Okay, so as the audit of the financial statement of Camden Corporation is being conducted by external audit, the external auditors are expected to certify the correctiveness of the financial statements, make a complete examination of the records, and verify all of Camden's transactions. Good luck. Okay. Give an opinion on the fair presentation, right, of the financial reports. Got to give that opinion. Okay. Give an opinion on the activities for investment purposes and contributes to the wisdom and legality of the business decisions. Pretty soon we're going to have us holding a seance. Speak to the spirits and see if the financial spirits. What does that mean? Truly mean. And the financial statements in accordance with this. Okay. Okay, good. The auditor's responsibility to express an opinion on the financial statements is explicitly represented in the introductory paragraph to the auditor's standard report. Now, interesting in that they don't tell us. Who observed that the other day? Another one of the questions where they needed to be more specific, didn't they? Because in the public company report, the introductory paragraph is the opinion, so I guess it's sort of the whole report. Whereas in the what? Non-public company report, the introductory paragraph does not mention that we're there to give an opinion. It's not until we get into what? Auditor's responsibility that we say it's our responsibility to give an opinion, and here comes the opinion, right? Okay, so they should have been more careful about what report they were talking about here, right? Okay. Explicitly represented in the scope paragraph. It's really the auditor's responsibility paragraph. Let's see. Yeah, or basis for our opinion paragraph. There really is nothing called the scope paragraph anymore. So I guess that makes that wrong. Explicitly represented in the opinion paragraph of the auditor's standard report. Yes, it is. It is explicitly represented in the opinion paragraph of the auditor's standard report. Oh, I see. It doesn't say that it's our responsibility to do so. But it doesn't say so in either. What are they talking about in the introductory paragraph? This question is a piece of crap. Okay, they're going by the old format of the report. And I apologize, I was just sort of looking, and I looked at it, and I selected the question that I should go pour over. Well, I don't know that it was pushed to say the opinion. This looks like it gives it, and I went ahead and included it. This is really stuck in the past, this question, that they didn't update the test bank for, because number one, they should have been careful to tell us what they were talking about, public or non-public. And secondly, there is no more introductory paragraph, scope paragraph, opinion paragraph. That's not how we're supposed to put together anymore. They're put together the way I'm showing you here, for a public company, non-public company. Okay? So I apologize for that question. That's not a good question. Audit evidence is what our opinion is based on. Okay? And we're going to consider the nature of the audit evidence, the sufficiency and appropriateness of the audit evidence, and then, of course, we will evaluate the audit evidence to see that it supports our opinion, or see what conclusion it brings us to. And all kinds of different evidence, records of initial entry, supporting records, spreadsheets, invoices, general and subsidiary ledgers, etc. Okay? Now, when we think about the quantity of evidence, this is whether or not we have what? Enough evidence to support our opinion. When we talk about audit sampling, we're going to see that if we have greater risk of misstatement, then we're going to need greater amounts of evidence. Higher quality evidence results in a lower quantity of evidence. Okay? So proper evaluation of evidence requires an understanding of the type of evidence available and the reliability, and I don't know why that says through unbiased and way. Okay? Okay, so what happens? Higher evidence is required, is actual auditor direct personal knowledge through inspection, through reperformance. Lower evidence is through observation and filing. Lower reliability evidence. Okay? So I like this right here. Okay? This is the key takeaway here in terms of the hierarchy of evidence. Okay? And so auditors' direct personal knowledge is the most persuasive evidence we have. Okay? Now, external evidence, evidence that comes from outside the entity, is the next most persuasive. So those goes from most persuasive to least persuasive. So if evidence comes from outside the entity, that is more persuasive than what? Than internal evidence, such as an invoice that is prepared by the client. Okay? Now, when we talk about external evidence, it could be external evidence that the auditor obtains directly versus external evidence that the auditor obtains indirectly. It could both be external. For example, I send out a confirmation to the bank, and I ask the bank to send that confirmation directly back to me, confirming the balance in the company's cash account. That is a higher level of external evidence than if the client has a bank statement from the bank, but then they hand that, the client hands that to me. Both of those are external, aren't they? But the fact that one came directly to me versus being first handled by the client and then given to me makes that bank confirmation more reliable than that bank statement, right? Okay. Internal evidence would be something like an invoice that is prepared by the client, but that would be what? Documentary evidence. It is more persuasive than oral evidence. Okay? Oral evidence is when they tell me something. Okay? Now, oral evidence in and of itself is never sufficient to support. Okay? You must combine it with another form of evidence, either the documentary internal or external, the direct personal knowledge. The direct personal knowledge is king. So if I sit there and I go and I say one coffee mug, and I see it, that's the best evidence, isn't it? If they tell me we have a coffee mug out there, that's useless to me unless I also see some other form of evidence, right? Okay? Okay, now, this evidence as it's listed here is for substantive purposes, for supporting what's in the financial statements. Okay? We're going to have to do a study and evaluation of internal control. And the evidence that we get in support of that study and evaluation of internal control is similar, but we use a little bit of different words. So instead of using auditor's direct personal knowledge for an internal control, you would use re-performance as the best evidence. So if I re-perform the control, now I'm putting myself in the seat of management, and I'm seeing, or the seat of the employees, and I'm seeing, do I think this control is prevent or detect a mistake in the financial statement? Okay? That is what? That is higher than observation. Observation, which is similar to what? Similar to the level of the, well, it's just a different list because we're talking about internal control. Observation is sitting there and doing what? Watching the staff perform the control. Now, that is pretty good, but when you watch staff perform a control, you always have to remind yourself that they were doing that what? That day when you were standing there looking at them, so they were on their best behavior. So you would most likely want to, where possible, I mean, if it's something like locking the door, how are you going to check that when you're not there other than watching them do that particular day? So some controls you just simply have to observe. Okay, but when it comes to what, if you can supplement that with inspection, so every time they lock the door, they have to sign a log. Now I can also see them lock the door the day I was there, and I can also do what? I can also see the sign off on the log, and they'll take a sample of those logs, so I can inspect those. Inquiry is the what? The least. That's like the oral evidence in which they're sitting there saying, well, we lock the door every night, common. Okay. You got to see that, right? It has some documentation. Evidence, something we can inspect or something. Okay? So similar list, but also different depending on whether we're talking about numbers in the financial statements, things that are supporting the assertion, versus what? Versus internal controls, right? Okay? Okay, good. Which of the following is the most reliable type of evidence? And so the reason I put that internal control little pyramid in there, because I noticed a lot of the questions sort of mixed the internal control evidence and the substantive evidence. Okay? And so confirmation would be an example of what? That's going to be sort of in the position of external evidence, right? Just coming direct, but still not auditor's direct personal knowledge, right? Whereas re-performance is more in the position of auditor's direct personal knowledge. So I sat there and I re-performed the control and was satisfied that it works. Inspection of records and documents is going to be what? It's going to be inspection. Okay, that's not as high as re-performance. Observation is what? Is going to be more in the, well, it's obviously under re-performance. Okay? Okay, good. Of the following, which is the least persuasive? Documents mailed by outsiders. The outsiders mailed me this. Sounds like they're from another planet or something. The outsiders. Information. If they're outside the company, right? So it's external evidence direct. Okay. Correspondence between the auditor and third-party vendors. External direct, right? Okay. Copies of company sales invoices inspected by the auditor. That is what? Internal, isn't it? Okay. computations made by the auditor, that's auditor's direct personal knowledge, right? Of the following, the most reliable type of evidence is performance. That's almost the same question. Just different order. Okay. Which of the following statements concerning audit evidence is correct? Appropriate evidence supports management's assertion should be convincing rather than persuasive. We do not give a what? We give reasonable assurance, don't we? We don't give absolute, that's the word I'm looking for, absolute assurance. Okay? Effective internal controls contribute little to the reliability of the evidence created. Yes, they do. If you have good controls, that helps you with the reliability of the evidence, doesn't it? That's why we look at the controls. The cost of obtaining evidence is not an important consideration. Hardy, har. That sound you hear is, you know, Price and Waterhouse rolling over in their graves, and Coopers rolling over in their graves. Okay? There's consideration of cost, believe me. Okay? Ernst just woke up from the dead and talked to Young. Okay? All right. The last one, a company's accounting data cannot be considered sufficient audit evidence to support the financial statements. Yeah. The accounting data in and of itself is nothing. Accounting data is what's in their general ledger, what's in their subsidiary ledgers, etc. We're looking for what? We're looking for corroborating evidence. We're looking for auditor's direct personal knowledge. We're looking for external evidence sent directly to the auditor. External evidence, not just what's in their accounting records, right? So we're there to audit the accounting records and if we're doing reconcile with the financial statements. Remember all those documents I wrote outside of the financial accounting records is what really constitutes the evidence on the audit, right? That's kind of a tricky question, right? Other than the fact that the other three are nonsense. Okay, all right, let's take a break, guys, right here, I think, and we'll go ahead and pick up after, what, 10 minutes? We'll come back at 9:30, 8:35, 8:35, and we'll pick up and we'll start talking about the system of quality control. Check 1, 2. Huh. I guess I can't change the microphone after I've started recording. Check 1, 2. Check 1, 2. Oh, well, I guess we'll have to finish it like this. Okay, guys, we're going to go ahead and get started back, and let's go ahead and talk about system of quality control. And let me start this out with asking the question, who plans to have their own CPA firm? Nobody? Huh? She's because she's not here. Volunteer. Kim, you're going to have your own CPA firm. Okay, so when Kim starts her own CPA firm, she's going to want to make sure that the audits are done according to standard, right? So what she's going to do is set up a system of quality control to make sure that what? That audits are done to standard. And when she sets up that system of quality control, she's going to follow the standards of quality control that the AICPA puts out, because when the peer reviewers come in, they're going to look to see that that system is in place. Now, a lot of times when people think about peer review, they say, oh, they're going to look at my audits. The audits, they'll look at the audits, and they do take a sample of audits and look at that. That's simply the end process. Most of the peer review is done looking at the quality control system, and then they select a few audits to see if indeed the audits did follow standard. Okay? So we've got two sets of standards going on. One tells you this is how you're supposed to conduct the audit. Those are those auditing standards, board and PCAOB standards we'll be talking about. Another set of standards, what? The AICPA's quality control standards tell you how to structure the firm so that the audits do follow those standards, those PCAOB and auditing standards, board standards. Okay? Okay, so we take a look and we need the elements of the quality control system, which requires leadership. And this is a tone at the top. Okay, so there's leadership. And leadership is demonstrated by what? By having policies, procedures, reminding the staff of the importance of independence, etc., right? Okay. Now, ethical requirements. So we're going to go ahead and we're going to make sure that we have a system in place to make sure that we maintain our independence, for example. In my office in the GAO, we had to confirm every time period that we did not have any conflict of interest. So every time we filled out our time card, we had to sit there and click that there were no impairments to our independence. We had to do it at the start of every engagement, and we had to annually fill out an independence disclosure as well, right? Okay, so these are the type of quality control procedures that would help maintain ethical requirements. Okay, acceptance and continuance of clients. We will have to do certain procedures to make sure that we accept clients, and the main reason not to accept a client is if you believe management lacks integrity. Okay, and so we'll have to do things there for accepting continuing clients. Human resources. We want to make sure that we hire people that have the appropriate requirements. That's why the CPA firms, although I think they're going overboard, expect you to have now 150 units of education before you come on board, and that which is kind of unfair, because that really goes beyond the bachelor's degree. Meanwhile, they want to hire people with bachelor's degree all the time into the companies, but then they can have additional units that really don't constitute a master's degree. Sometimes that's a little unfair. But we would have those sort of controls there for human resources. Are we promoting people on a timely basis? Are we providing the appropriate training, et cetera, right? Human resource considerations. Engagement performance. Engagement performance. So we should have standards that make sure that we're following these standards as we engage the performance. Monitoring. We should have, for example, a pre-issuance review on every audit, meaning that another partner, independent from that engagement, will look at the report before it gets issued to check for things like independence, that sort of thing. You can follow the appropriate standards, the conclusions by the staff appropriate, those sort of things. Okay? So all of these would be part of our quality control system. Yeah, I knew there was a mnemonic for this. The mnemonic is help. So we have what? Human resources, engagement performance, we have leadership, we have what? Oh no, E is ethical requirements. P is what? Engagement performance. And then M is monitoring. Help me. Okay, so you can remember those elements of the quality control system that you want to help. If you volunteered, you would start your own CPA firm.
Oh,
You were gone?
that's funny. I do want to do that.
Oh, okay. No, that's very good. What's your name again, sir?
Jerry.
Jerry?
Yeah.
Jerry somehow knew that about you. Did you tell him that?
No, I've never told anyone. I've wanted to tell my job. That's My wife.
He still wants to get married?
Yes.
He's still going to get married?
Yes.
CPA firm, no.
Yeah, he's a finance guy.
Oh, okay.
Yeah.
Oh, okay. Power couple.
Yeah.
Okay, so you can remember the elements of the quality control for yourself. Very good, Jerry. That's great. You know things about people that they haven't even disclosed to you yet. Watch, keep an eye on this. Okay, good. All right, now, this was the issue about how frequently you'll get a PCAOB review. PCAOB, guys, now this is PCAOB selected individuals who come in and do these PCAOB reviews. This is not the peer review. The peer review, you engage with your peer reviewer, okay? Then it has to be from a selected list of AICPA approved peer reviewers, okay? But you select and you engage with them. Here, the PCAOB comes in. You auditing a public company? How many did you audit? Said 200. I'll see you next year, right? I'll see you this year, and I'll see you next year as well, right? Less than 100, and it's every 3 years. Okay? Or 100 or less. Over 100. Okay? Okay, good. Which element of the system of quality control? Huh? Did you say something? I'm hearing voices again. Which element of the system of quality control strives to provide the firm with reasonable assurance that policies and procedures are operating effectively? That's the monitoring, right? Okay. Human resources is hiring. Leadership is the tone at the top. Ethical requirements is making sure we're independent, but the policies and procedures are operating effectively. That's through monitoring, right? Okay, which of the following is an element of a system of quality control that should be considered by a public accounting firm establishing its quality control policies and procedures? Lending credibility to clients' financial statements, using statistical sampling. That might be in the standards to perform the audit, not the quality control standards, right? Membership in the Center for Public Company Audit Firms. I don't even know what that is. Is there such a thing? Sounds like someplace you go and get unaddicted to audits. I'm going to the Center of Public Company Audit Firms because I'm booked on auditing. Acceptance and continuance of clients for specific engagements. Yes, right? We did have the what? If we look back, we had the relevant ethical acceptance and continuance of clients. Did I give you part of the mnemonic? Human resources, ethical requirements, leadership, performance, monitoring. Okay. Well, rather than say help me, I got a better one then. We'll say help Ma. And that'll be acceptance and continuance of clients. Help Ma. Help Ma do the dishes. Okay. Okay, good. An important role of the Public Accounting Oversight Board is to oversee issuance of financial statements by issuance of statements by FASB. That's the SEC's job. Preparation and grading of the Uniform CPA exam. That's the AICPA's job. Even though your scores are given to the state, AICPA corrects it, right? Okay. Peer review of member firms of the private company's practice section. That is the AICPA's function. Okay. Regulation of firms that audit public entities. Yeah. Okay. Hello, public company oversight board. Which of the following is true with respect to the PCAOB? All firms performing audits of public entities are inspected every year. No. Only those with 100 or more, right? PCAOB inspectors are conducted by partners of other CPA firms. No, it's PCAOB employees essentially that come in doing that, right? PCAOB inspection teams review a sample of audit engagements conducted by the firm as well as the firm's system of quality control. Right, that's what peer review, what they do, and in peer review, that's what they do when PCAOB comes. Deficiencies from sample audit engagements reviewed by inspection teams and deficiencies in the firm's quality control are publicly disclosed on the PCAOB's website. Okay, but that's not what? That's not a. That's not true with respect to their inspection process. That's the result of their inspection, right? You can go to the website and see the results of their inspection. Right there. And so you can go and see them, but that's not part of the process. That's the result of it. Firm A perform audit of 60 public entities, while Firm B perform audits of 120 public entities. How often must each firm undergo a PCAOB? Firm A will be inspected every 3 years. They're less than 100. Firm B, every year, they're more than 100, right? Okay. Ethics is going to refer to system or code of conduct based on moral duties and obligations. Okay. Professionalism refers to the conduct and aims or qualities that characterize a profession or professional person. All professions operate under some type of ethics or code of conduct. Okay. So we are going to take a look a little bit later at the AICPA's Code of Conduct. And the Code of Conduct basically gets into high-level principles, then there are rules, and then there are interpretations of rules. Okay, so principles are sort of high-level things that talk about what we ought to do. We ought to be independent. Okay, rules tell us what? How to implement those broader principles. So no direct ownership in a client is a rule that supports the what? Independence principle. Okay? And then interpretations of the rules will give us specific requirements. For example, no direct ownership, family relationship. However, if the family member is not involved in the day-to-day accounting, that would be more of an interpretation of the rule. Okay? I feel like I should take this slide out at the end of each one of these chapters. I mean, why does the guy have to be so miserable? Okay? All right, so why don't we do this? Part of me wants to go to chapter 3, but I think probably better. You want to look at the homework and quiz questions, or you want to go to chapter 3? Homework and quiz from chapter 2, right? Okay. So let me get to that. Is there a question? Huh? Oh, you wanted to add it? Go ahead.
I already did.
Oh, okay.
I just want to know if you can know.
You want to know why he's spying on you? No, I'm just kidding.
My diary.
You write that in your diary? Oh. Okay, so again, guys, Chapter 2 homework, Chapter 2 quiz, extra questions, which is all of the multiple choice questions from the homework. Okay, and then extra exercise questions, which are all the exercise questions. There's not that many of them. Okay. Okay, but let's just go ahead and let's look at the ones 2 of you have done it already. Okay, good. Which of the following best demonstrates the concept of professional skepticism, relying more extensively on external evidence rather than internal evidence, focusing on items that have more significance quantitatively, quantitatively affect the entity's financial statements? I mean, that is a concept of materiality, okay, but not the concept of professional skepticism. Critically assessing verbal evidence received from the entity's management. I gave you the example when they told me, well, gee, we don't have visibilities to their audit reports. I'm like, how? Right? And we looked a little bit deeper. We found out we do have that information, right? Evaluating potential financial interest held by auditors in the client. I don't even know if they call that means. Okay, but clearly the right answer is what? Being critical, okay, about what you hear, having a questioning mind, etc. Okay, good. Let's take a look at the next one. Ordinarily, what source of evidence should least affect auditor's conclusion? Oral evidence, right? Inquiry of management. External evidence, documentary evidence, inquiry of entity legal counsel. Okay, so those are both inquiry, but there's an expectation, I guess, that the legal counsel will be under obligation to be more frank with us, more open with us than management will. Okay. The most reliable evidence regarding the existence of newly acquired computer equipment. Now remember, guys, we talked about the assertion in our first class. Assertions are made up of financial statements. Existence, we're going to do what? Go from the financial reports to the supporting evidence, which in the case of a physical asset would be what? Going in actually looking at that asset if we're inspecting it. And that's auditor's direct personal knowledge, isn't it? Okay, so physical observation would be the direct personal observation. Documentation, inquiry, evaluation of client procedures are not nearly as convincing as the auditor's direct personal knowledge and physical observation. Or which of the following procedures provide the most reliable audit evidence? Inquiries, inspection of pre-numbered client purchase orders. Those are internal documents, aren't they? Inspection of vendors' sales invoices received from client personnel. Although it's external, it was held first by the client personnel, right? Whereas what? Inspection of bank statements obtained directly from the bank is external direct, right? Question? Which of the following topics is not addressed in the auditor's report for a public company? Absolute assurance. We do not give absolute assurance. It is what? Reasonable assurance, right? Okay. Which of the following combinations would provide the auditor with most reliable evidence? Source is what? Going to be external, and this external evidence is more effective, isn't it? Okay. Something that's external and more effective. You could have external evidence that's less effective, but obviously we want what? More effective evidence, right? Number 7, which of the following is true with report to PCAOB inspectors of accounting firms? PCAOB inspectors review a sample of audits as well as the quality control system. Like I said, sometimes you'll have deja vu because I posted the question in the slide as well. Okay, so you've seen them in the homework, but we could also have seen them in the slides. Number 8, which of the following combinations of standards and types of audits are most likely related to the activities of PCAOB? And they develop auditing standards for the audits of public companies. Not non-public, that's what? That's AICPA, right? No statements on auditing standards. For non-public, that's AICPA. Develop statements on auditing standards for public entities. Okay, well, you know. I'll try to stay away from dumb questions like this on the test. It's not called statements on auditing standards. It's called what? Auditing standards. Statements on auditing standards is the ICPA title. I'll try to stay away from dumb questions like that. Okay. Number 9, which of the following principles is most closely associated with the auditor's conclusion is a fair presentation? That's the reporting principle, right? That's where we state our conclusions. That's where we give our opinion. Number 10, the evidence considered most appropriate by auditors is best described as what? Direct personal knowledge. Okay. All right, good. Want to do the quiz then?
The quiz and the extra questions,
Mm-hmm.
I think they need some. Showing apprentices.
Doesn't look hidden. The only way I would hide it from you is if I hit that eye and get blank the eye out. Chapter 2 quiz shouldn't be hidden. I don't know what to tell you. There's nothing I can do. They've got an eye there. If they want me to hide it, I hit that eye. Now it's hidden. When I unhit the eye, it's now visible to students. So I don't know what's happening. Huh? Okay. I have no control over that. I don't know. It doesn't say that it's hidden. Let me try this. Maybe it somehow thinks I haven't assigned it. Go to edit assignment. Huh? Except it's already May. It's past May 20th. Huh? Probably going to tell me I have to select a date that's current day and time. What is it right now? 9? Suitability do 9. Okay. It's going to be like that, is it? Go ahead and refresh. Huh? You see it now? Okay, what about these other ones? Are you seeing these extra? I don't know why that would be. I sat there when I signed it. May 21st at 2:57. Aren't we past 2:57, or am I missing something? What is it now? 9:04? Yeah, this thing's a little temperamental here. Are you seeing that one now?
Yeah.
I don't understand why it would be a problem. Because when I said, when I put it in there, it's now past that time. Ugh. What time is it now? 9, what? 05? Better hurry.
Oh, 9. It is cheap.
And it should be as long as I select a time that's before or I don't know. Okay?
Yeah.
And you can see the chapter 3 ones?
Yeah.
Okay. I don't know what's going on. Okay. All right, let's look at the chapter 2. We're going to do the quiz, right? One student's in progress. You guys aren't messing around. Okay. Okay. Okay, so responsibilities. Responsibilities under generally accepted auditing standards do not include, and what? Competence and capability was a responsibility, and dependence was, due care, planning and supervision was part of the performance area, right? Which of the following is an element of system of quality control that should be considered by a public accounting firm in establishing its quality control systems? Who are we supposed to help? Who are we supposed to help? You forgot who you're supposed to help already? We're supposed to help Ma, and the A in Ma is acceptance. Okay? Lending credibility, we used this one already, huh? Using statistical sampling members, so we saw this question already, right? An important role, regulation of public entities. We saw that one. As I said, some of these you'll have seen. Which of the following is not considered a type of evidence? Auditor's calculation, auditor's physical observation, verbal statements made by client personnel, even though it is a lower level of evidence, it is evidence, right? Okay. Whereas the entity's trial balance, the books and records of the company are not evidence. We're getting evidence in support of what's in those books and records, right? An audit of financial statement at Camden is being conducted by external auditors. The external auditors are expected to do what? Give an opinion. And fair presentation. If you saw that one, or one very similar. Which of the following procedures provide the most reliable evidence? Inquiry of client accounting staff, inspection of shipping documents, bank statements obtained directly from the financial institution, right? Analytical procedures performed by the auditor on the client's trial balance. Even though the analytical procedures that we're going to talk about in Chapter 3 will help us to determine what parts of the financial statements require a deeper look, in and of itself, it is not evidence it supports. It simply is a tool used by the auditor to direct your attention on the audit. Number 7, which of the following would most likely be a violation of the independence requirement found in the responsibility principle under generally accepted auditing standards? An auditor on the engagement has a distinct, we saw this one, right? The auditor on the engagement owns a financial interest in the stock of the client. That's a what? Prohibited direct ownership, right? No matter how small. The auditor's responsibility to express an opinion of the financial statements. This question is bad, right? I can't cross it out here. Okay, but this question is wrong. And Kim and I were looking at the textbook. The textbook has the outdated opinion for public companies. That opinion is outdated. The one that I have in the slides is the up-to-date opinion, and if you don't believe me, I'm sure you do, but it mirrors, go look up Apple. It mirrors what we saw in the Apple statements that we looked at on the first day. But I put in there in the slides. Okay. Number 9, under generally accepted auditing standards, responsibility relates to professional skepticism and judgment. That's right off the slides. Number 10, which of the following would serve as a source of professional guidance? I don't think we saw this one. Okay. What? For a public entity, obviously PCAOB, but yes, the Auditing Standards Board standards where PCAOB doesn't speak to something, right? You can use the Auditing Standard Board requirement. Which of the following is not true with respect to the responsibilities for establishing generally accepted accounting principles, auditing standards for both public and private entities? We saw that question. It's not for the private entities, right? SEC is over the public, and the PCAOB require the responsibility for private is the auditing standards for the ICPA. Pronouncements issued by the PCAOB are subject to formal approval. We saw that one. SEC. (13) Which of the following system of quality control strives to provide the firm with reasonable assurance the policies and procedure being performed? We saw that one. It's monitoring. 14, we saw right? Firm A every 3 years because they only audit 60 public companies versus more than 100. And we did this one, didn't we? We did this one together. Okay. All right. Any questions? Looks like we're going to be one chapter behind in class. So we'll deal with that as we come to it, okay? Because I'm not going to start chapter 3 at this point. There's no point. We'll go through chapter 3 entirely next time. All right, and you do a homework for 3. To get through 3 faster, we'll start 4, whatever. We'll figure it out. All right, guys? Huh? Okay, I'll see you next week.